A few years ago, most businesses in the UAE cared only about their trade license, visas, or their bank accounts. And usually, that was enough. Tax residency certificates were always important, but corporate tax changed who cared about them, how deeply they were examined, and why businesses started prioritizing them. And what's interesting is a lot of businesses still don't understand what it actually proves. This is FintEdu's Let's Talk, and today we're going to be discussing tax residency certificates. We're joined by CA Pooja Shinde. She's the founder at EmpowerTax Consulting, and she helps various businesses with UAE taxation as well as cross-border structures. It's a pleasure having you here, Pooja.
Thank you for having me, Delwyn, and it is a pleasure to be here.
Perfect. Pooja, I wanted to start off from the basics just so that we can set the groundworks. First, I would like to understand about your experience, your time in the UAE, how it has been so far. And I want to ask you for this experience with the context of the topic for today, tax residency certificates. A lot of people have heard about it, about TRCs, about double tax agreements, but I feel like not a lot of people know the implication or the whole scope of it. Could you help us understand what is a TRC?
Surely. So we will break down your question in 4 different parts. Firstly, about myself, I am a qualified chartered accountant from India. I got qualified in the year 2015 and carrying almost 10 plus years of post-qualification experience, and overall, including internship, 15 years of industry experience. My core area of expertise are tax and compliance, but beside that, within my firm, the consulting firm that I am currently running in Dubai, which is EmpowerTax Consulting, we are effectively offering tax and compliance service, and other than that, providing support for the internal audits, accounting and bookkeeping services as well, and beside that, due diligence or related aspects. Practically within this firm, our aim is to provide all the services under one roof which are required for the small scale businesses in the possibly cost effective manner. Regarding my work experience, I have my COP, which is Certificate of Practice, issued by ICAI, and I was practicing in Mumbai as an associate with one mid-sized consulting firm. I did my practice for almost 78 years, and since 2023 I have relocated to UAE, Dubai, and since then I am working in the same domain, which is tax and compliance. I was leading a consulting firm's tax and compliance department earlier for almost 2+ years, and after that, in last 1 year, I started my own firm, and that's about the working experience.
Right.
Coming to your specific question as to what is TRC, how it is becoming predominant concept recently, and especially after the introduction of corporate tax, how it will help get some more benefits in the context of double taxation avoidance agreement, which is a very important concept from the international taxation point of view. And we'll elaborate on this because that is the topic for today's discussion. Very interesting concept it is. It is tax residency certificate, which is basically an official certificate issued by the Federal Tax Authority to the applicant, and it is actually stating or confirming a fact that that particular person or a company is effectively a UAE tax resident for that particular financial period.
Okay. So, very interesting statement, and this kind of is a natural question. Even me particularly, when I think about residency, the first thing that comes to mind is the pink sticker, the e-visa that you get from the authorities. Is being a UAE resident not automatically making you a tax resident?
That is an interesting question actually, because many people have this misconception that UAE residence visa automatically gives you a status of tax resident in UAE, which is not the case. I would like to clarify that. Residence visa is typically immigration residency, and TRC essentially is a tax residency. It has a linkage with number of other aspects, especially from the tax and compliance perspective, and in terms of eligibility part as to what is the differential factor between these two, or what is TRC in detail. Federal Tax Authority and Ministry of Finance, they have actually laid down proper tax laws covering this important aspect, even elaborating the procedures and eligibility part of it.
Okay, interesting. So in essence, residency or residence visa is the right to stay, whereas tax residency is something else altogether.
Yes, yes.
Okay, very interesting. You did mention earlier that TRCs have been around for a long time, but now with the introduction of corporate tax in the UAE, it is now gaining prominence again. Would you like to throw some light on that statement? Why do you think that's the case?
Surely. I think before we delve into this particular aspect, I would like to throw some light on the eligibility part of it, because that would lead us to the next answer.
Okay.
So in terms of eligibility, TRC can be obtained and applied by both persons as an individual or company. A person has a test of, typically there is a test of 3 criteria. It is called as a 3 layer test, or different three kinds of criterias are there. Any one of the criterias, if a person is able to satisfy, then he or she, they become eligible for the TRC.
Okay.
So this 3 test rule, the first rule is interesting, which is 183 days rule, essentially, that if a person is physically present in UAE for that particular period during a relevant 12 months period, then becomes eligible for the tax residency application. The second rule or the test, we name it as 90 days rule.
Okay.
This rule is a combination. Basically, if you are not able to meet the first criteria of 183 days rule, you can try and see if you are able to meet the second criteria. For example, if you are present in UAE for a 90 days time,
right,
in a relevant 12 months period, and along with that you have a better commercial and economical interest in UAE. For example, you are either employed somewhere, you have the employment contract or the employment visa, or you have a business activity here by way of having a license held by for a company, or maybe a freelancer visa for the business activities. And the third and the interesting part would be if you have a permanent residence here by way of obtaining an immovable property,
okay,
or that kind of larger interest. So this is the second test, which is a 90-day rule test.
Okay.
If we talk about the third test, which becomes relevant for those people who are not able to satisfy first 2 criteria but still have commercial and economical interest,
okay,
in UAE. For example, they have family here, or they have typically we say residential abode here, or they have larger commercial interest here by way of related party transactions,
right,
those kind of setups, or maybe economical dependency, etc. So these 3 criteria are there for the test in terms of eligibility for the individual.
Individuals. Okay.
And if I have to speak about the company's eligibility, then companies in terms of all the licensing I would say structures, be it mainland company, free zone company, even the government company, free zone entity for that matter, they can become eligible for obtaining the TRC provided they are able to satisfy all the prescribed conditions.
Okay.
And last and interesting part, because you briefly mentioned about it, even foreign entities who are effectively managed from UAE,
yes,
they may also become eligible for obtaining the TRC if they are able to satisfy all the eligibility criteria.
interesting. So I feel like that's a very interesting take on it, and you have explained that part of it very beautifully. I wanted to kind of merge 2 of my doubts into one. First, again, with corporate tax now in the way, has TRC gained more popularity suddenly? That's first. And second, for an average business, how does the TRC make any difference? What benefits do they derive from it?
I think this is very, very important question to understand from all the businessmen point of view, even the existing taxpayers per se. Answering the first question as to why it has become more relevant in the recent times, especially after the introduction of corporate tax, I would say 3 reasons. UAE is not unilateral dimensional jurisdiction now.
Right.
It has become evidently significantly global tax hub. Okay, and that's the reason now. See, what the TRC is kind of giving you is, it is establishing your position from the angle of tax presence,
yes,
in UAE. Essentially, your operational setup, your economical presence and substance, and your tax position is being cemented in a way by issuance of this TRC.
Right.
Secondly, other jurisdictions globally, they are now well aware of the fact that UAE also has a tax now.
Correct.
So they are more or less emphasizing on a fact as to what document, a taxpayer or a company or a person residing in UAE can provide them to substantiate or to prove that they are effectively tax resident here. Essentially, that is this document, which is TRC.
Okay.
So all the foreign jurisdictions, let's take an example from the tax department from India. They are asking for the TRC from UAE. Be it banks, be it international tax forums for the DTAA benefit, etc.
Correct.
Essentially, because it is a well-known fact now for the entire globe, I would say, that there is a tax in UAE. So they are just willing to focus on obtaining some kind of official document or a certificate in order to ensure that, okay, things are, in a documented format available in UAE. It is
Correct.
not just a verbal communication and assurance anymore.
Understood. And from the point of view of, again, I'm assuming most of your clients, they would also have heard about TRC but may not have delved into it further. What kind of benefit does the TRC provide, just for a layman to understand?
Sure. So see, let us try and understand as to, basically there are two different kind of TRC certificates practically being issued by FTA. One is domestic TRC,
Okay.
and one is tax treaty based TRC, which is essentially being used for the double taxation avoidance agreements.
Okay.
Now when I mentioned about DTAA, basically out of all the 195 countries recognized globally, 113 countries are listed with DTAA agreement of UAE. That
Okay.
means they have the mutual DTAA agreement in present scenario or present case,
Understood.
in the relevant for the present financial year. Now, essentially, when a particular company or a person, if they think that they have multinational presence, then there could be a situation where effectively they are becoming a tax resident of both the countries.
Okay.
For a particular, say, source of income, or there is some kind of conflict or complication in terms of facts that are those which are being analyzed, they are becoming a dual resident for a particular, say, source of income, for a particular segment of reporting. In that case, they have to rely on the double taxation avoidance agreement. They have to structure out and analyze their position, and TRC from UAE will essentially help them to avoid paying taxes on the same income in both the jurisdictions.
Okay.
Yeah. And coming to a specific question as to, for a common, for example, businessman or somebody who does not have a great amount of knowledge in terms of tax and compliance, TRC will essentially provide them an assurance in the return form officially from the tax department that they are a tax resident in UAE. Okay, obviously it does not automatically relieve them from the paying the taxes elsewhere. That is something that we have to differently analyze and conclude, but they are able to get a return official certificate from the department. And since TRC is being issued financial year wise separately, for each year they have to analyze their position
Okay.
and accordingly go ahead with the application.
Interesting. So is it possible that the standing that they have or the position they have can change every year?
Definitely, because it is entirely based on the facts
Okay.
that we are analyzing. And in case of an individual, like I said, it is linked to their physical presence in UAE. And in case of companies, interestingly, it is linked to multiple factors.
Yes.
Effective place of effective management from UAE would be leading the list. But other than that, having proper economical substance over here, strategically their decisions should be taken from UAE. Effectively, their board meetings should be conducted in UAE.
Right.
It should not be a fact that somebody else is sitting, maybe in the rest of the part of the world, and they are effectively managing the company. They are taking the financial decisions for the company. That should not be the case. So what we are trying to understand here is FTA is now largely focusing on ensuring a fact that companies are effectively operating in UAE and not just on the paper.
Right.
So substantially they are going behind the documentation and paperwork, in a way behind the curtain, to understand how the things are working in UAE, and by way of giving that benefit to you, by issuance of TRC, they are actually providing required clarity in terms of your own tax position here.
Understood. I think this all will make sense with a little bit of context, and for me the easiest place to draw context would be the past. So do you think the way UAE structures were, say maybe 5-6 years ago, do you think those structures would face a lot of scrutiny in the date today, the way that tax is being analyzed?
Again, very interesting question, and there cannot be a simple answer to this question, because before 5 years obviously there was no direct tax here.
Yes.
There was no taxes being imposed on the business income effectively, and when the situation has changed, everyone who is directly or indirectly connected or related to the UAE tax jurisdiction will have to reanalyze and restructure their entire business transactions and economical and commercial setup. And like I said, they have to review their position almost every year.
Yes.
Because it is not something that will say standard and I would say unchanged year on year basis. So that would definitely change the entire scenario, and now there can be no financial decisions which a company or a person can take without giving a particular context to a particular tax provision.
Okay.
For every transaction effectively that they are planning to execute or they have already executed, maybe in the relevant 5 years also, since you mentioned about previous 5 years, if there is any transaction which is still not closed or it has some carry forward effect, they will have to again kind of analyze their position in terms of that context as well when we are talking about the TRC part.
Okay, that's very interesting. And I feel like what you just mentioned, if a transaction has a carry forward effect, then that also should be considered, which I think a lot of people may not have thought about when considering this. I have one more question regarding TRC or the basic application of it. Is it possible that a person can be deemed to be a tax resident of the UAE, but they are not actually a resident of the UAE, like they don't live here? Is that a possibility?
Okay, so again, this question needs to be analyzed for individual differently and for companies differently.
Right.
I'll cover the companies first, because in companies cases, to analyze the position of tax residency, there are simple and set rules. There cannot be if and but. There could be situations like dual residency, what I mentioned, where they have to take references of both the treaties, and still if the conflict exists, then they have to check all the facts and the context of the case, and based on that they have to take the decision. Okay. Per se, there is this concept relevant in UAE, which is deemed tax residency, but automatically it does not get triggered.
Okay.
They try and understand the context first, they try and analyze the facts first, and then only that concept will get triggered. And for the individuals, I feel the rules are quite simple. Again, how that will have impact on different jurisdictions. For example, I mentioned about India's context.
Yes.
As to if somebody who is a non-resident in India, if they are not becoming a tax resident in any other country, automatically they are becoming a resident there.
Yes.
Which means deemed residency is getting triggered. Their global income would be subject to tax in India. So having the income sources for these two jurisdictions analyzed separately, and how and where a particular person becomes a tax resident in that particular financial year, that needs to be separately analyzed and concluded. There cannot be a simple answer to this question. Also for the reason that the financial year being followed in India or maybe other part of the world, it could be different than what we are following in UAE, which is essentially a Gregorian financial year.
True. That gives a lot of clarity on this particular aspect. Let me kind of pick what you mentioned earlier. You mentioned something which I found very interesting. There could be a case where a company which is incorporated in the UAE they are conducting business here, they apply for a TRC, they get the TRC, and then when they submit it to another country, the other country may say, no, I don't accept this because I don't think your management is in the UAE. They may have some proof or some evidence to the contrary. This very neatly ties into what you mentioned earlier about effective management and control. Can you help us understand what effective management and control is?
Basically, the place of effective management would essentially be analyzed and concluded when we are applying for TRC by the FTA itself rather than somebody to whom we are submitting this.
Okay.
Because ideally, direct tax here, corporate tax, is essentially based on self-assessment. What this concept tells you about is, at the first place, department would be willing to rely on the facts and figures and the circumstances that you are claiming to be in terms of what documentation you are providing.
Correct.
They are willing to rely on the information that you are providing, unless and until they are able to find some facts which are contrary to what you are submitting.
Okay.
And that will essentially cancel your TRC application at that particular stage itself.
Okay.
So I feel there cannot be these kind of circumstances where we are obtaining the TRC from FTA, but somebody else is kind of maybe denying the acceptance of that. There cannot be that particular situation. But essentially, FTA will go ahead and conduct, I would say, enhanced due diligence before issuing TRC to you, especially if you are operating in UAE for a longer time.
Makes sense. And when you say that FTA or the authorities would conduct enhanced due diligence, if they will want to check more things, what do they generally look for? What is their assessment based on?
Okay. So while answering this question, essentially I will first have to try and answer as to what are the standard documentation that the FTA asks for. And in the exceptional cases, if they are going for the larger scrutiny or a detailed I would say verification of the facts, what would be the documents that they might ask for? So for companies, they generally ask for standard set of documents which cover company's trade license, MOA copy, then shareholders passport and Emirates IDs.
Right.
They ask for company's 6 months bank statement for the operational bank account. This is typically for proving the economical substance.
Yes.
Earlier audited financial statements, that particular set of document was also mandatory, but as recently as last 1 year they have removed that requirement.
Okay.
Which has provided ease to the taxpayer.
Yes.
Other than that, for companies they ask for the Ijari.
Okay.
So what we understand from the set of documents that I mentioned, that essentially they are willing to check how company is operationally setted in UAE, and if they want to go into the details as to how the economical substance can be proved, they have a lot of ways. They can ask for maybe bank statement for some other bank account. They can ask for bank statement for longer than 6 months duration. They can essentially insist for the audited financial statements or even unaudited financial statements.
Okay.
They can ask for submission of work orders or proving of business operations or maybe sales invoices, etc. So in terms of financial information, they can ask for some more information. What we are essentially following in AML as well, as to what is the source of income, how it is being effectively managed, how when we talk about the management, how the company's emails are being used in terms of conversation or communication internally and externally.
Correct.
Whether company has a proper website and whether it is operational, and how overall the resources have been placed in UAE. So there are a lot of these kind of parameters that FTA can try and touch upon, I would say, before concluding a case.
Very interesting. And again, like you said, the first instance they are willing to accept your facts, but they will also want to check, and these are the different avenues that they will check. That makes a lot of sense.
Yes. Which would be, I would again like to just add one point, that in my case I have not experienced any kind of enhanced scrutiny or additional list of requirements whenever we have applied for our clients for the TRC. In all the cases we have got the TRC issued at the first place itself, for the very reason that it is very, very essential for us to understand the eligibility part first.
Yes.
Before going ahead with the application.
Very interesting. and thanks for sharing that insight. I have a question. I'm not sure if it's a duplication or a repetition, but it's something that stems a doubt in my mind. You did mention that a company could be claimed as tax resident in two countries, right? Two different countries can lay claim to that. Have you come across any case as such? What were the instances in that scenario, and what is the solution? Do you have anything to share on that point?
Okay. So let us first understand the basics as to how the dual residency can get triggered, and then I'll try and elaborate on a particular instance that we have come across. So for a particular source of income, for example, a UAE company is generating some income from one of the foreign jurisdictions by way of some contract they have completed over there or relevant kind of transaction. So from that country's perspective, there are certain criterias. If those criterias are satisfied, that income becomes taxable income in that particular foreign jurisdiction. And
Okay.
there could be a case that there is withholding tax over there,
Right.
essentially, which is TDS. For example, from India's point of view, we used to call it as tax deducted at source.
Yes.
So, for the reason that this particular company, which is UAE incorporated company, essentially they are claiming to be a tax resident by default, because how the UAE corporate tax regulations work, that any company which is incorporated in UAE by default becomes a tax resident unless proved otherwise.
Yes.
So in this case, they have to essentially convince in a way to the other jurisdiction that they are tax resident here, and that particular income which they have generated in that country is not subject to tax there. They are eligible for the exemptions based on whatever is the nature of income. For that, they have to refer to the double taxation avoidance agreement and relevant article numbers,
Right.
because for different kinds of incomes, there are different articles. So why it becomes relevant that in case they fail to prove that that particular income is not subject to tax in that country by way of referring to all the DTAA references, and in turn by submission of this TRC from the UAE, that country will deduct taxes.
Okay.
And in a way, indirectly, they have to complete all the procedures over there.
Right.
When the taxes are being deducted, they have to complete the procedure in terms of they become a taxpayer over there, they have to file the relevant returns, in turn obtain some maybe tax deducted at source certificate, TDS certificate, and in turn relate or correlate that in terms of reporting in UAE.
Okay.
So while giving this example and scenario, I explained and kind of have answered your question in terms of how an instance can arise where a dual tax residency might get triggered.
Right.
But by way of issuance of TRC, by way of properly analyzing the DTAA provisions, a taxpayer or a particular company can maximize their tax planning and structure.
Appreciate that answer very much, because like you said, it's not just as simple as I apply for TRC and my job is done. You still need to know where your income is from, under what articles you will qualify for the exemptions, and I think the answer you've given has basically put a lot of light on that. Now coming to the actual process of the application itself, you just some time ago mentioned about the different things that they may ask for a legal entity or a company, which is trade license or MOA or ID documents of the shareholders or bank statements. What do they ask of an individual who's applying for a tax residency certificate?
Okay, so from the individual, they are asking for a very simple set of documents. Essentially, the first and important document would be Emirates ID in UAE, which is other than that there could be residence visa, then passport would be there. Over and above, FTA asks for your entry and exit immigration record, which you can either get from the ICP app, or you can get it attested and printed form from the maybe any Al-Ansari exchange or those kind of platforms.
Okay.
Essentially, it is immigration record for the entry and exits in a relevant 12-month period.
Understood.
Over and above, they ask for 6 months bank statement from the UAE local bank account that an individual is maintaining. This is an important concept, not from the foreign bank account.
Country.
And there could be Ijari or tenancy certificate that can be submitted. Other than that, if a person is salaried, they can try and submit their salary certificates for 3 to 6 months period, or maybe employment contract, which will prove their, in a way, larger context in terms of tax residency. Lastly, if a person is having freelancer visa, then accordingly they can submit those particular source of income documents.
Okay, very interesting. Something that I've heard consistently in your answers is for a given 12-month period or for a given period, right? How important is timing when you're applying for a TRC? Because there could be some instances where companies jump the gun. They do it too early when they can't prove substance. How important is timing?
I think again this is very important point or aspect to understand from everyone's point of view when it comes to the TRC application. For an individual, when I say relevant 12 months period, basically it is a financial year itself. For an individual, they don't have an option of having any other 12 months period followed for the application.
Okay.
It has to be a set Gregorian financial year. For example, if an individual is already staying in UAE, if they are able to complete or pass the first test of 183 days, then essentially they can apply for their TRC after say June 2026 for the ongoing financial year of 2026,
Okay.
because they have effectively completed 183 days time. For companies, there is no defined financial year.
Yes.
It is there from the date of application, they have to go back for 12 months period and check all the criterias.
Okay.
In terms of their operation, in terms of having their maybe financial statements, bank accounts, operational, etc. So essentially then there cannot be a TRC application which we are doing for the future period.
For the company.
Yeah, for the company.
Okay.
And even for the individual.
Okay.
So I'll break it down for the better understanding. So for companies, for 2026, if they have to apply for the TRC, if they have already satisfied the conditions, they can apply for it after 31st of March,
Okay.
after completion of first 3 months for the relevant financial year.
Okay.
Okay, but they need not necessarily follow only this 12 months Gregorian financial year as a reporting period. They can take any 12 months period, and if the first 3 months are already completed, because in the application you have an option to select the financial year and it can be different from the regular financial year.
Okay.
So like I said, a company can apply anytime after the completion of 3 months, say on 1st of April, you can go ahead and submit your application. Here effectively you are getting TRC for the future period, but it is only the part of the future financial year.
Correct.
First 3 months are essentially need to be checked.
Yes.
For an individual, depending on under which test they are basically fitting into, if 183 days rule is there after June, if they are checking the second criteria, then once they complete the 90 days they can go ahead with the application. Okay. And very interesting fact that I would like to mention is FTA portal automatically calculates your eligibility criteria in terms of number of days stay by populating your number of days stay in UAE. They have the data linked with the immigration.
Okay.
And only when you are satisfying 90 days they will allow your application to proceed. For an individual,
Right.
they have that, because once you enter Emirates ID and passport details, system has everything.
Right.
So TRC application in UAE, basically I would say it is super simple. Very set rules are there. There are no complications as such if you have a simple set of transactions or setup.
Interesting. And the fact that it is linked, I would say it means that you don't have to calculate as much, but it also means that there's no scope for you to then bargain or negotiate, because those are the facts. When it comes to applications, it's all simple, which is great. Do you come across rejections or delays in the applications? Are there any specific reasons that you have come across for rejections or delays?
There could be some reasons as to why we can at times face rejection from the department whenever we are applying for the TRC. The reasons could be, for example, in case of individuals, what happens is generally they don't have profiles already created with FTA.
Okay.
So like you said, otherwise we don't have to sit and do all the calculation in terms of checking the 90 days criteria.
Correct.
If they have already profile created, they can just go ahead and check the details by way of filling the application itself. But if the profile is not created, they have to do the offline calculation, and if that calculation is wrong, in case of individual, there is no possibility of rejection because your application only is not proceeding. Okay,
Right.
but in case of company, if you have not checked your criteria for the eligibility very particularly, for example, a company is operational only for 3 months period. They have checked the first 3 months criteria for the application and just went ahead and submitted the application, but they don't have 6 months bank account,
Right.
which is essentially one of the mandatory requirements. So there could be these kind of reasons. So the first reason that I mentioned about that, not having the eligibility criteria checked very particularly and just submitting the application. Second reason could be they do not have all the required documents properly submitted to the FTA as per the say requirement list. For example, ijari copy is not there, or maybe the applicant's documents are not properly uploaded. So application should be properly filled before we actually get the response from the FTA. Third reason could be there is mismatch of name, for example, in case of company, in their trade license, in their FTA profile, in their bank account. There could be these kind of discrepancies, I would say, which can lead to the rejection.
Okay.
The fourth reason that I can try and mention is effectively that company is not managed from UAE. Still they have applied for example, say this is a foreign company.
Right.
And they are claiming to be effectively managed in UAE, hence trying to obtain the tax residency here by way of this application, but they are not able to prove effective management.
Right.
So FTA can reject that application based on the facts and the circumstances which have been submitted. So these could be some of the reasons. Otherwise, like I said, TRC application is super simple, straightforward activity. There are lesser chances for the rejection unless and until the eligibility is not properly checked.
Very interesting. There is something that I feel a lot of businesses are starting to realize, or they haven't thought about it earlier. They used to think that okay, TRC is just another document, no one is going to check so much. But now in the field we know that this is taking a lot of time. It is going to be very seriously checked, because the repercussions of it are obviously not just restricted to the UAE but other countries as well. Do you think there are any common misconceptions that companies or entities have in the UAE? Like, say for example, they focus primarily on the certificate rather than creating the substance that will back the certificate.
Good question, actually. My answer would provide some more insights for you as well as to all the podcast viewers. There is a misconception from individual point of view that okay, if they have the residence visa, automatically it is giving them a tax residency in UAE, which is not the case, like I explained. There is misconception with companies setup that if they have a trade license here, automatically they are becoming a tax resident in UAE, which is again not the case. Like you said, economical substance, having a proper set of operations here, a company being effectively managed and controlled in UAE, all the strategic decisions and financial transactions conducted from UAE, all these are underlying criteria that a company must check and satisfy, and then only they become a tax resident here. So these are the few misconceptions which we can mention here by way of this platform, and hence my recommendation as a tax consultant to most of my clients who are companies having multinational presence is in advance at the start of the financial year itself or the relevant reporting year, whichever they are selecting, try and analyze your position in terms of having a tax efficient structure in UAE.
Right.
Because having aftermath discussion, because like I said, TRC gives you a lot of benefits in terms of avoiding double taxes payment, in terms of establishing yourself as a tax resident here. In terms of providing, I would say, a foundation for the future years, for the maybe growth or expansion that you are planning at the group level. So there are long-term implications that a particular decision or the reporting will carry. So that needs to be very particularly analyzed in the company's context.
Very nice answer. So since you've spent some time in the field, since you've assisted a lot of clients with the activity of TRCs, obviously corporate tax has been around for just under 2 years now?
3 years almost, yeah.
Right. So do you think, have you seen any sort of changes from the 3 years that corporate tax has been in, specifically with regards to TRC? Have you seen any changes there?
Okay, so FTA I think has been emphasizing a lot on the TRC aspect. Having said this, I can give few examples. For example, FTA as recently as on 3rd of October 2025, they have changed the mechanism as to how the TRC application fees were traditionally being paid.
Okay.
For example, earlier an applicant used to pay amount in two parts. Firstly, they used to pay 50 dirham as application fee, which was a nominal fee.
Right.
And once the application is analyzed, reviewed and maybe approved by FTA, they used to pay remaining 500. This example I am giving for an individual, for example, who has the say TRN here.
Okay.
Because for non-TRN holders the fees are 1050.
Okay.
So referring to the same example, if an individual having TRN here, for example, he is providing some consultancy in individual capacity, has taken the VAT registration, which is a kind of TRN in UAE. In that case, earlier he used to submit an application by paying 50% application fee and 500 he used to pay only when the application is approved.
Okay.
So there is no financial risk lying with the applicant.
Yes.
But since 3rd of October 2025, FTA has asked that entire application fee needs to be paid in advance.
Okay.
550 you have to pay upfront, and interesting fact is that if your application gets, either you are cancelling it or FTA rejects your application or there is subsequent withdrawal by the taxpayer itself, there is no amount is not refundable. Basically there is no refund that you can expect from the department.
Okay.
Amount will be forfeited.
Okay.
In a way. So what essentially it reflects that FTA is willing to give that understanding to the taxpayers that they have to analyze their eligibility in advance very particularly, and then only they should go ahead with the application. And secondly, entire financial risk has been shifted to the applicant than FTA.
Correct.
And that is one interesting, I would say, recent change, answering to your specific question. And second recent change in terms of TRC would be, for example, I'm not sure if this would be the right platform to mention this, but in the 113 countries for the tax treaty that I mentioned, interestingly, United States of America, USA is not there.
Correct.
Many other countries, maybe those countries' name we might not come across on day-to-day basis. Those countries' names are there, but USA name is not there.
Correct.
So when a company as a applicant or as our client, they are approaching us for the double taxation avoidance agreement related tax treaty TRC, we specifically do ask them in advance as to what is their end use, what is the country for which they need the tax treaty. And we also ask them if there is any special form that this particular foreign jurisdiction needs us to submit.
Okay.
Because there is one special form that FTA can issue on a particular request.
Okay.
For example, in case of Saudi Arabia clients, Saudi Arabia, they ask for a form called as Q7B to be filled by taxpayer. There are certain declarations and that form can be stamped and provided by FTA.
All right.
Because different jurisdictions, they have their own rules. Essentially, the applicant from UAE, they have to first check what are those formalities, and in turn FTA provides that platform where they can kind of apply and get those documents signed and stamped.
Interesting. So I think through your conversation you've mentioned there has been a shift in the way that the FTA is handling things, or even if you leave FTA aside, the way that the industry is now looking at these tools at their disposal, do you feel like the authorities or the country as a whole is shifting towards a more substance-driven tax environment?
Certainly yes, and it is this answer as yes is I would say backed by the facts. FTA per se as a department or as an authority is essentially providing lot of support to the taxpayers, be it by way of keeping the tax regulations, laws and rules in a super simplified manner. Any layman can read the rules and understand the implications. You do not have to hire typically a tax consultant or chartered accountant or tax agent for basic interpretation. So the rules they have kept very simple. Secondly, whenever they are imposing any new regulations or introducing any new facility, they try and provide lot of trainings by way of conducting webinars, by way of providing FAQs, by way of making some other educational I would say documents, source documents available on the public domain. They try and provide all the required support to the taxpayers, where taxpayers are not feeling the burden to suddenly shift from their existing traditional way of managing the businesses. They are being provided this training, they are being provided I would say good transitional time in order to shift from the older to new scenario. And like we all know now that FTA is quite approachable. Yes. You can they are literally a call away, and right now they have also started this facility of having online meetings also aligned.
Okay.
There is a booking platform that they have provided specifically where you can have a pre-appointment taken for a particular topic, and you can have that face-to-face discussion over the video meeting with the officer. So these kind of facilities, what essentially FTA is trying to give the impression to the taxpayers that they are with us throughout the process when they are essentially implementing some kind of new I would say regulations or facilities or launching something which will eventually cement a stronger position as a tax jurisdiction globally also for UAE.
Interesting. So I think we've learned a lot throughout this session. I have a few quickfire questions that I wanted to ask you. Simple questions. If you could just answer them very briefly, I think we're good. So the first question that I have in mind is, what is one myth about the UAE's tax residency certificate that should disappear?
That having a residence visa automatically gives you a status of tax residency.
Is there one document that UAE businesses don't give enough importance to?
In terms of documents, I would say they should plan in advance, because there is no future TRC which is being issued. It is always on the historical data, and when I say in advance, before the completion of a particular period, say 3 months, they have to plan their position and then go ahead with the application.
Interesting. Are there any particular red flags that the authorities will immediately catch?
For example, whenever they are seeing their bank statement, for example, for a particular company, essentially if there are no bank transactions, or there are only for example, they have introduced share capital, there are some minor bank charges etc. debited to the P&L account, there are no any other set of transactions reflected in the bank statement, effectively there are no operations done by the company. That could be one of the red flags. Second, which we have already covered in the earlier discussion, that for the standard set of documents, if anything is missing and still they have gone ahead and did the application, that is also a red flag. But FTA has been considerate enough to provide you one opportunity or even more opportunities. They write back your application by way of asking some additional information, and they give you that opportunity to resubmit the application basically.
Understood. So that draws me to my last question for today. What is one major piece of advice that you would like to give to businesses with regards to their UAE tax residency?
See, UAE as a tax jurisdiction has, I think, evolved significantly, and in terms of technology, in terms of support being provided by the department, in terms of having a very sorted, simple system in place, I think UAE is already a way ahead of many foreign jurisdictions, and it is trying to provide a business-friendly environment to the I would say taxpayers as well as other entities. So one piece of advice that I would try and give is, obviously refer very particularly you have to monitor all the correspondence that you are received from the FTA. You cannot ignore,
Right.
because all the due dates you are getting the messages, reminders, everything. So effectively there is nothing that FTA is not providing you support on. Only and if you are trying to be a tax compliant company or an individual, essentially you should try and monitor all the correspondence, follow all the latest updates issued by the FTA. If there are any clarifications required, use all the platforms provided, be it in terms of providing submitting some inquiries, maybe getting an appointment booked with the FTA officer, get that clarification, then move forward. There are certain other platforms for the private clarifications or such aspects that they can avail. So basically there cannot be a situation where because of lack of awareness there is some default.
Right.
That is something that as a business you can avoid.
Interesting. It's been a pleasure speaking with you, Pooja. Thank you so much.
Same here, Delwyn. Thanks a lot.
The UAE Tax Residency Certificate is not just an administrative document. It sits at the center of treaty access, international tax exposure, business credibility, and global compliance expectations. And as we heard today, the conversation is no longer just about where a company is incorporated, but where it is genuinely managed, controlled, and operating from. Let's talk.